Good morning, boys and girls. Welcome to the Flow Show. It's Tuesday, it's CPI day, it's Valentine's Day. I haven't received many cards from you lot. Anne, where's my card? Bit disappointed. I was expecting a couple to land on my doormat, but I won't hold it against you, don't worry. Morning, Stel.
Hello, happy Valentine's Day.
Laying out the rose petals today, have you?
Sorry, have I what?
Been laying out the rose petals for the missus today?
You know it. It's also my dog's 11th birthday.
Oh, happy birthday to your dog. What's your dog called?
Millie.
Millie. What is
One
it?
of I have two. It's a well, it's not the breed. We got it from a shelter. So
Nice.
yeah, a little medium-sized white dog, kind of a cross between a Labrador and a smaller dog.
The old Bitzer brand, yeah? Bits of this, bits of that.
Exactly.
Good stuff. Well,
yeah.
I hope so, mate?
No, I just said yeah. So all good.
Yep. Well, I hope everyone has a good day today. Great trading day today. There's going to be lots coming up, of course. So let's get stuck into things. In China, the SCMP, South China Morning Post, had a sources piece out saying that China and Australia normal trade resumption may be at hand. So that's been an ongoing story. We've been talking about easing of tensions between those two countries, and a possible easing of tension since the Balloon Gate saga, as Blinken may be going to meeting his counterpart in China. That meeting may be back on. It was set to be on a week or so ago, but it got knocked back with all this balloon stuff going on, but that might be back on. As I say, SCMP sources saying that, but US Deputy Secretary of State Sherman says they are open to a meeting with China when it is in the US interests and when conditions are right. So still may not be quite there yet. In Hong Kong, the HKMA has been intervening in the market. As we know, Hong Kong dollar is at the top of its band. Oh, I've lost it. Where's he gone? There we are. So what they can do is sit there intervening when it's really up against the level, that 785 level, and they'll throw plenty at it daily if need be. I still remain short up there. Over to Japan, and GDP numbers we'll start with first, because they were a little bit mixed. Not as high quarterly as expected, coming in at 0.2% versus 0.5 expected, but that was up on the minus 0.3 prior. Year on year as well, not up as high as expected, still confirming that GDP is starting to go in the right direction anyway. We have noted previously from the data that it's been a bit mixed, manufacturing a little bit softer, but services have been doing a bit of the pulling. So not all going in a straight line still. CapEx numbers there, not looking too good though, down 0.5% versus minus 0.2 expected, so worse than expected. Consumption though coming in as expected, so on the spending front things aren't too bad as far as we've seen there. So a bit of mixed numbers going into this new period of the Bank of Japan new governor, and yen has pretty much not done an awful lot, seeing as we've had the confirmation that Ueda is going to be nominated or has been nominated. There's two deputy nominations as well. A BOJ Executive Director, Uchida, has been announced, as well as ex-FSA Chief, Himino, both put forward as deputy new governors. Not much out from the man himself, but he did say, Ueda this is, if Parliament improves my appointment, I will do my best. Well, I don't know what else he was going to say. He's not going to do his worst, is he? But we'll wait and find out. Some of the ministers coming out after that nomination and on the GDP. Economy Minister Goto said that GDP data show Japan's economy is recovering gradually. and that they will take necessary policy response without hesitation, with a close eye on economic and price developments. Achieving sustained wage growth is the best way to combat rising inflation. Okay, strange one, that one. Rising inflation, well, it's going up, but not exactly rocketing away. Anyway, Industry Minister Nishimura said that he hopes the new BOJ governor will lead Japan out of deflation and complete Abenomics. That's still going on there. Now, as I said, we got the move, well, not much of a move. We hit these highs late in the day yesterday, or yesterday afternoon, in towards the fixed time. And then we just basically sort of dribbled lower throughout the rest of the day into the evening. Not much move really on the UEDA confirmation. I thought there might be a bit more of a knee jerk. I think the jury's still out on this guy. And I had a train of thought yesterday that although his comments when we got those headlines dropping that he was in the frame were saying that the Bank of Japan is right to continue with easy policy, I've been thinking that if Japan is on the verge of finally seeing inflation, if there's going to be wage increase coming, if finally after all these years of easy policy, Japan may start to get what it's wishing for in terms of a pickup in the economy and inflation, then Kishida has already said he wants someone who can communicate well with markets, particularly if there needs to be a change. Kuroda going, Amamiya not taking up the role or put himself forward, and in fact leaving as one of the big proponents of easy policy, means that Kishida wants to take another direction. He wants people in place that are not like for like, because these guys have been one way for, you know, over a decade now. And so it needs a change in direction. It needs a change in leadership to who he thinks perhaps is people who will lead monetary policy to change. As I say, there's no point going like for like if you want that to happen. So maybe the market has got a little bit over dovish on Ueda in terms of what he may mean. That doesn't mean he's going to walk in the door and start hiking rates, but it could mean that initially any comments that come from him are not going to be boat rocking. He's not going to upset anything, but he may potentially just start to change language very subtly, because that's what they do in Japan, to speaking more about if and maybe they need to change policy. And that will be the key for me, because it doesn't take a lot in language change in Japan to move markets. So I would expect him to come out and say the same old lines that of policy, what they need to do now, maybe just start talking a bit more about the future if they get to a point where they need to look at exiting. But all that's going to happen maybe if we get any comments in the press, but we've got these confirmation hearings 24th and 27th of February in the upper and lower houses. So that's when they'll be on the spot, and we'll get a full sense of what they mean. But for dollar yen, it's not really done an awful lot, considering what it did when we got those rumours last week. No real move on the confirmation. We're sitting pretty much in the middle of yesterday's range, all waiting on the CPI to come, and that'll be our focus later on today. Looking at a bit more data. In the UK, we got jobs data, and let's just put that up. And not too bad numbers, actually. Claimant count coming down, so those people claiming for unemployment dropped. 13k was expected to rise near on 18k. The 3-month employment change was up 74k, so a strong number there. Can't see it on there, but the payrolls number, which is another number that comes out, i.e. people who register with the HMRC as being on the payroll, rose 102,000 versus what was it, 47k previously. So strong numbers there. And then we've also got obviously the wages. Now the main wages number came in at 5.9, so missed expectations and was lower than last month. but strip out the bonuses and they came in higher than expected, 6.7%, versus 6.5 expected and prior. So wages on the gain there. Now, obviously, our glass half empty press still pointing out the negative impact of wages, or negative real wages, with inflation running at 10%, 10.2%, and those wages at 6.7%. There's still a gap over losing, that 2.5–3% in wages in real terms. Still, these numbers are some of the highest the UK has seen, at least since before the COVID crisis. So wages are still moving up. And just to add to that, in terms of the inflation impact, there were two headlines out in the UK yesterday. Mobile and broadband firms are going to be doing their price rises this year, and they're going to be quite significant. Now, what a lot of firms do around April, May time, they raise prices by the January CPI or RPI, plus usually between 3 and 4%. Now, with RPI currently at 13.2%, I believe. Let's get the numbers up. RPI is at 12.9%. and CPI is at 10.3%. So those prices will be going up by add 4% onto those numbers, and that's what these firms are going to be boosting consumers' bills by. So that's going to be 14 to 17% increase in bills coming in to the market, and that's going into the inflation pipe. London bus drivers have accepted a measly 18% pay rise after their strikes. So you want to talk about inflation coming in and whether it's going to fall back? I've been saying it for a while in the UK. It's not going to fall back as quickly as markets expect. Still expect the Bank of England is going to have to hike higher than they think as well, and a lot of the market thinks. So here we have two inflationary pressures here of 17 and 18% coming into the market over the next few months. That's on top of all the other strikes that are still going on: train drivers, nurses, teachers, refuse collectors. There's still a ton of that to come through yet that haven't been resolved, and they're probably going to be up at those sort of numbers as well. So inflation not likely to pull back as quickly in the UK. What do you think of it, Stel? 18% for a bus driver?
Crazy. Yeah, I mean, from the numbers that we got today, the one that stuck out to me was the fact that average earnings ex bonus are rising, but including bonuses are dropping, and there's a big gap, right? And so basically, bonuses have collapsed. Just interesting. But like you said, also there's a huge pinch on the consumer because inflation is multiple percentage points above the average earnings growth. So this is going to be felt by the consumer, and it's something that the Bank of England has many times in the past told us that, and there's something they do consider. So, with all these numbers and inflation being a lot stickier in the UK than, say, the US, you would assume that the Bank of England would be really hawkish, and they're one of the most dovish central banks. So, go figure that one out. With two members already voting for a no rise for 2 meetings now, and also one of them, I can't remember the name, was talking about a cut. Yeah, exactly. Was talking about a cut. And I'm like, you can't be seriously talking about a cut with numbers where they are now. If you see a trend in inflation dropping, just like we've had in the US, 6 straight months of drops and another one expected now, you can potentially start talking about it. But the UK, I mean, I don't get it. But we've said it many times, every opportunity they get, the Bank of England is one of those central banks that they will always err on the side of caution and of dovishness, which doesn't make too much sense at times, but that's who they are.
Yeah, you say err on the side of caution. I say get it wrong every time.
Get it wrong every time. Yeah, that's another one. Another way to say it. Yeah, I don't know what to say, man.
No, but that presents a good trade for us because, as you say, if they are forced to go high, if they are forced to turn more hawkish, that's potentially beneficial for the pound, and something that the market is really underpricing at the moment. So that's a potential trade opportunity. We'll keep watching the data, keep watching these wage prices, these strike numbers, and see if they get resolved, and we'll see what happens. As I say, that's where the opportunities, the trading opportunities come. Right, looking at the US, Fed's Bowman says the concept of a soft landing is unusual to accomplish, but we still see a very strong labour market, but not as much moderation in inflation as we'd like. Then there's lots of data between now and the next policy meeting. We will continue to raise interest rates. Now on the Fed, President Joe Biden is apparently going to name Fed Reserve Vice Chair Brainard as his top economic advisor, and that announcement may come as soon as today. So Brainard is obviously one of the big wigs at the Fed, will be leaving to join Biden. So we'll have to see who steps into the hot seat with that one. Obviously not the first Fed member to join the government, with obviously Yellen as Treasury Secretary. So, it is a thing that happens among there. And speaking of Fed rates, Reuters were out with their latest poll on the US Fed funds rate, which now sees economists expecting the rate to peak at 5 to 5.25%. This is up from 4.75 to 5% in the January poll. However, the Fed won't cut rates, said 54 out of 80 economists, who said that the bigger risk is the Fed's funds rate will peak at a higher level than expected. And that was said by all 37 economists asked that question. So we've seen it in the market moves, we've seen it in yields, we've seen it in the dollar. There has been a shift towards the more hawkish side now. The pivoters have had their moment, and the hawks are now taking back control modestly. So a step up in expectations there. CPI data is going to add to that or take away from it today. And let's look at the numbers expected. So headline CPI expected to drop 2 pips to 5.5%. The core number also expected to drop 2 pips to 6.2%. Anything probably plus minus 2% around this number will get a lesser market reaction. However, if it comes in, if that 2% is on the upside of expectations, i.e. meaning these are unchanged, that's going to feed the hawks, and we're going to see yields rising and likely the dollar following suit. If both move down, it's going to be on a scale of that move down. As I say, a 2 pips loss worse is just going to feed into the narrative that inflation is falling. If we do see any big variation to the downside, then again, that's going to suck some of this recent expectation, hawkish expectation, out the market somewhat. There's lots going on. Stell's been banging on about it for weeks, that there could be a significant downside number if these new measurements and the new weightings pull out a lot more than what they usually would in terms of the stuff that drops off from the previous years. Conversely, a lot of the market are paying a bit of attention to the monthly numbers, saying that they could come in much hotter because of these same weighting changes and everything that's going on. So we've got lots going on. We've got a situation where the market is already sensing there could be some skew here. So even if we do get a big number, some of the economists, analysts, whoever who dig into the data may come out and say, okay, yeah, it's a big number, but if it wasn't for these changes, it wouldn't have been as bad, so on and so forth. So it's going to be a question here of, does the market A, believe the data it gets, and does it react fully to the data it gets? For me, it's still a binary risk. If the data comes in hot, if inflation comes in hotter, i.e. not dropping as much as expected, that's going to feed the hawks. If it comes in much lower than expected, that's going to take some of the life out, and the pivoters are probably going to start pushing their side of the trade as well, which will mean dollar lower, yields lower. It really is a mess.
If I may add one thing, I think if CPI comes in line, so if it drops 0.2, I think that's going to be how should I put it? It's going to be risk off. So basically, it's going to be, for me, it's the same as it coming, unchanged or 0.1 lower. I mean, if it only drops by 0.2, that kind of pace, the pace of slowing of inflation will be dropping, because we've had some nice little chunks lower every print. 0.2 lower, might indicate that the rate of change of inflation is coming to a standstill. And where is that final inflation rate going to be? If it went from 9.1 to, actually, let me see the numbers again. 1 second, I'll open them up here, and I want to explain what I mean. So we went from 9.1 to 8.5, so that's 0.6 lower, then 8.2, 0.3 lower, and then 7.8, and then 7.1, and then 6.5. So this is a pretty, decent pace of inflation cooling down. If that slows down, then that could potentially show us that we're reaching a bottom in inflation, and that will mean the Fed has to do a lot more. So I would say that even with an inline drop, it's going to be not good for risk. It's going to be the same as if it comes in 0.1 higher. So I think it needs to come in quite a bit below expectations for doves to be basically happy and risk to be rallying from here. I think that's the most likely scenario. Of course, I could be wrong, but all I'm saying is if it comes in at 6.2 year-on-year CPI, I think that's not going to be good for markets.
Yeah, it's all really going to depend really on what happens. Let's see if I can do some drawing. We had a similar situation on the way up. Inflation rose strongly, then it sort of went sideways a bit, and the market thought, is that it, before going on? And we could get a similar sort of thing here where maybe it does that, then before heading down again. So it wouldn't surprise me to see things holding up. There's been enough bits and pieces, oil rebounding, coming off the lows, and other stuff, that's food prices, that sort of thing, that haven't dipped back as significantly. We've still got this shelter stuff in the mix, which a lot of people looking at, in the services side, saying that it's still a bit sticky there. So yeah, I wouldn't be surprised if we do see a bit of moderation coming in. The question is, does it go down like that, or does it then start picking up again?
The main question is, what does the Fed do when it starts to ease off and plateau like that and bottom? The Fed will come in and be probably even more hawkish than they've been so far. So the market will have to do something finally. If that happens, has to kind of correct and price rates going forward a little bit more aggressive. Yeah,
perhaps. But I think if it really depends. This is a tough thing. We're talking, number watching. If it comes in at 6.2 as expected today, and then then we see 6.1, 6.2, 6.1, and it's up and down. It's going to look sideways. The Fed are just going to, I think, stand still on that. They're not going to turn hawkish or more dovish. They're just going to say, we need to watch the data, and the data's showing that inflation has, maybe petered out a bit, or the drop has slowed down. If we see it picking up, then we're going to get more hawkish, but we think it's going to continue down. I'm a fundamental trader. I'm a long-term trader, and I traded this when it was going up because it was very clear. This isn't so clear. What's happening over now isn't so clear. Yep, I expected inflation to come off from the highs last year. Was saying that in the latter part of the year. We've been seeing it, but for me going forward, I don't know what it does. I don't know if it continues to keep coming down. I don't know if it goes sideways and starts going up again. If I had to pick a side, I would say it's not perhaps going to come down or continue coming down as fast as it has been, unless some of those weighting changes the whole picture. So from a fundamental point of view, I'm in wait and see mode. I haven't got as strong an ideal or feeling for the fundamentals over here that I did have when inflation was rising. And that's, that really needs to be reflected in my trading. Dollar yen, I'm still happy to sit in my shorts, but I'm not going to go offside too far if the data and the price action is telling me something different. The price action here speaks for itself. We're in this zone. Let me just put it up there again. We were speaking about this zone pretty much all year, all the start of this year, where I'm expecting, get rid of that stuff, get off, a potential consolidation phase. We tried the downside. 127 was where I thought the price may run into trouble. From the big move down from the 150s, that's where it's run into trouble. The upside, where's it going to run into trouble now? 133 is already showing up. 134 is my next area. Unless we get a significant move in inflation, either the trend keeps continuing or, whatever happens, this range is likely to be in play until we get something different. So that's all I'm going to do trading wise. And particularly for this CPI data today, I've got my levels. I know where I want to potentially trade. If we get up to 134s, 134 and a half, then I'm probably going to play a short-term short and maybe add some into my long-term short. Conversely, if we get back down towards the 128s, 127s, I may let off some of my short and maybe look to take short-term longs to see if the ranges hold. So that's going to be my trading guide going forward today. I'm not necessarily going to say, oh, this print means that this is going to happen over the next 6 months. It's going to be, right, well, this has happened today. What has the price done today? Pick your levels, euro dollar, up to 108s, maybe even 109s. That's probably around a good stretch point. If the data is pretty weak, i.e. lower than expected inflation, we're going to see the euro rise. And your levels up at 109. We've had a go at getting up above 109, couldn't stay there for long, and look at the pullback we've got now. So all the hard work has to be done again in these areas. The first area 108, then this 108 30 70 zone, then 109. So it's going to give you opportunities today, whatever that happens in the data. So if you're not a fundamental trader, if you're not looking 6 months down the line, 3 months down the line like I am, you've got your levels. You just trade your levels. And the same thing on the downside. Move to 105 is probably out of reach, 250, 260 pips away. But, it may get down there over the next couple of days if the data is really strong. And if that's the case, 105 is a level I'll consider trading for the short term or otherwise. Get in a trade and see what happens. And if you get under 104s, 104.50, you're wrong. You're wrong. Where your risk is leveled at. What are you looking at still today? Are you going to react to the data? Or are you just going to let it play out and then pick up the pieces after?
Well, it depends on the number, but usually I let the market kind of settle down because we've seen recently the first reaction usually is not the right one. We've seen a fake out and then move the other way. Obviously, if the number is big either way, then I think the initial reaction is probably going to be the right reaction. But on anything less extreme, I don't know. The first move is often treacherous. Exactly, Bran. Yeah. And it's caught me out a few times. So I'm taking it a bit slow and I'm going to let the market quiet down first. Now, what am I looking at in particular? Well, you know me, I always look at silver. And the other one I'm looking at is dollar MEX, which seems to be breaking down or almost breaking down now. And if we break the lows from 2019 and 2020, sorry, which was the COVID lows, the pre-COVID lows, actually, what is it? Dollar MEX was 1850, I think. So
Yes,
we're really close. Yeah, we're really close. If that breaks, I mean, if you zoom out a bit, it's the abyss below. So, I mean, realistically, I mean, I don't want to sound extreme, but realistically, the first huge support is 1550. So it's a big move percentage-wise. And also, remember, if you short this pair, you are collecting a pretty nice carry. So, uh, I like this trade on the short side. So for this to work, obviously the inflation print has to be weak. We need the dollar to be weakening. And so this effects wise, this is the one I'm looking at. There are other pairs that might interest, but really this is the one because of the carry as well. And
Yeah,
but otherwise, I have a tiny quarter size only long in silver, which is out of the money now. I always want to have something in it, and I am going to be looking at levels. I'm going to looking at the reaction. First real level for silver for me to the downside is a fib, and also the 50 DMA, 200 DMA, sorry, which is at around 2090, 2089, I think it is. It's a 50% fib from the COVID low to the high that we had in 2021. And also there's also, yes, the 200 DMA. After that, there's an ascending trend line which comes in in the low 19s now. So I am going to be very, very patient with this. Silver has been good to me over the past years, and I don't want to rush it. I usually accumulate slowly. Now on the upside, obviously the big level remains 2450 on a daily close, and there's also a descending trend line which is now coming at a little lower than that, so it's probably around 24. But we're still a long way away from that. So yeah, to answer your question, I'm going to be grabbing my popcorn, watching the markets move, and then deciding after thinking about it a few times and then a few times more.
yeah. I think you're right. And Brand's right. The first move can be treacherous, and it has been, because particularly with this, as I say, there's a lot of market who are trying to dig into the numbers and these new weightings and what it means. Will it skew the number a bit more than it actually means, if you know what I mean? So you're going to get the reaction initially to that numbers dropping. Then you're going to get the analysis saying, well, actually, maybe it's not as good or not as bad as the numbers say. And then you get the secondary or real reaction. We've seen it over plenty of data before, so it's important not to get sucked into the early reaction. So if you can avoid it, as I say, look at your levels, go through your charts, and score your levels. So you may have 5 or 6 different levels that's come out a little bit. Maybe 100 to 150 pips away. And you've got all these levels, and you put them on your chart, and you say, right, which ones am I really wanting to trade? Which ones that I'm going to get stuck into? And then that's how you score. You say, right, well, the price is 107.67. That's 33 pips away from 108. That's not a lot. That's not going to stand up on a big weak print. It's going to blast through that. So I'm not going to give that a high score to trade. 108.30, well, that's 70 pips away, 80 pips away. Again, it may be a bit close. I'm going to give that a lower score, maybe a bit higher, but still not a very high score. 108.70, well, now I'm going to score that a bit higher. 109, I'm going to score that even higher. And it's a mental thing you can do to just say, these are levels I'm going to look to trade. And if they don't get there, they don't get there. If you find that they come up to these levels that you didn't score highly, they bounce a bit for a while, and they don't look like breaking, then you can get your conviction that that's as far as the market wants to push it. Now maybe I'll trade those levels. But from the initial point, do your homework, plot your levels, and score them, and pick the ones you really would want to trade. And that way it helps your risk. You're not just jumping in and trading every level you got on your chart. You trade that one, you get stopped out for 20 pips. You trade that one, you get stopped out for 20 pips. Well, your next trade, you got to make 40 pips just to break even. So give yourself the best opportunity to be right in your trade. And so if you're wrong against it, you maybe only lose 20 pips once, rather than trading every level and losing 20 pips on all your levels. So looking around some of the other pairs, obviously I'm going to be doing a lot of managing of trades I've got on. I've got my levels here. We know 70 is a level, but again, we're pretty close. So, a real lower number CPI, that'll go. I'll set my sights up here at 70, 60, 70, the old level, then into 71. If we get up there, I think, unless something's really changed, that'll be somewhere where I'll potentially look for shorts, short-term shorts, because I'm still long-term long, and just to play the ranges. And we've moved away from this zone down here now, 68, 70, 80. So that's a consideration now, give or take. We're 80, 90, 100 pips away. That'll be a point I'll look at. If we get a strong CPI number and the dollar gains, that's the area I'm going to be looking at to trade. Will it hold a support? Will it break? If it breaks, will it fake out like it has before and then bounce right back? So I've got my markers. If we get under there, great. Can we get under here? Can we get under those prior lows? We need to wait and see. If we get under there, will this level then hold as resistance? We don't know till we get there. So all I'm doing is planning the areas and levels that I would consider trading. If they happen, they happen. If they don't, they don't. Move on. Next piece of data, next piece of news, and we go on from there. Euro sterling looking like it's on a little bit of a minor break. We've got this 88.2025 area, former fib that we were watching previously. It's become a bit of a natural support and resistance area. We're just getting a move under it now, which probably means we're going to get a test of the big figure at 88. More support down there, bit of a zone between that sort of 75 and 80, 90 area. So keep an eye on that if we get down there. As much as the jobs report from the UK and wages numbers were fairly good, I don't see us going all the way back down to 85s or anything like that. I am still long a bit though, so I am going to be watching this trade very closely, because if the Bank of England is forced to turn more hawkish, then obviously we could see this coming down much lower. I don't think we'll see it today, but if my key level is still down towards this 87, 87.20, an old area of support and resistance, goes back quite a way. So that's my main level. Under there, then we're potentially heading down towards the 86s. But in the meanwhile, all the top side hard work is still to be done. Again, if we're going to get a move back up towards 90. I know Steele's not ruled it out, neither have I, but the price action at the moment is saying getting to 90 is a bit of a tough ask. So before we move on to some of the other bits and bobs, boys and girls, give us your thoughts, what you're looking at today, how you're looking to trade things. Are you picking anything in particular? Are you in any trades? How are you going to manage it? Let us know. We're happy to talk about it. So what is it really all going to mean? I mean, this is the biggest piece of data still since the last biggest piece of data. And until the next biggest piece of data, we've still got retail sales and PPI this week. So it's not a case where you can even take this CPI and think, right, well, that's it until the next FOMC. Data is really important at the moment, isn't it?
Yeah, of course it is. And but I do think that this inflation print is by far and away the most important one. But yeah, obviously data like retail sales, they will show the consumer's ability to spend, and hence this will get translated into the upcoming inflation numbers as well. So it's all important, but we have to understand what's the really big market moving ones. There are a few, and I think today's is definitely the biggest one, because I've said this so many times. What was the main reason why the Fed started hiking like there's no tomorrow? Inflation, nothing else, right? Obviously, inflation is driven by a lot of things, and there are many data points that point towards that. But really, what the Fed looks at is the inflation number. That's their mandate. So for me, without a doubt, it is the one.
Yeah, exactly. And again, I think, like we had the other week with all the big central bank meetings, it's where we finish the week is going to be important as well. If whether we finish inside the ranges or if we've had any breaks, because if we finish inside the ranges, it's going to tell us that the market is pretty happily priced where it sees things going, which means it's going to take something significantly more than that to break us out of the ranges. So I think that, you have to take all the data as a whole. The CPI is big tier data. It is important, but the retail sales are going to be important for whether we're soft landing, hard landing, no landing. The PPI later is going to say whether inflation something's going to happen to the next CPI report, because PPI is a bit of a leader, if you like, and it lags or CPI lags the PPI stuff sometimes. So it's good. It's going to give us plenty of volatility this week, particularly if you're just looking at the short-term numbers. Abir wants to look at cable. What are your thoughts, Abir? Let us know. What are you looking at? Are you looking at shorts, looking at longs? Have you got a view? Again, we're pretty much looking like we're going to be middle of the range at the moment. 124s, 120s. That's the levels we're going to be messing with. That's the highs and lows of the range. Obviously, we know how big this 124, 124.50 is. Decent double top. We've had a little test of 120, had that little fake out below, clear out all the longs like me who took a little long above this. And we've pushed back into the middle now. So it's a 50-50 trade, in my opinion. We could go up and test 124. Maybe we go back down and test 120. I don't need to have a view on the pound. I don't need to have a bias on the pound. All I need to know is what levels I'm going to trade. And that's potentially 124 or 120. It's going against you one now. You're already short. We'll stop at 123. Yeah, I think I don't know where you're short, but I think it is a bit middling here. It could go either way. So I wish you well with your trade, and I hope it goes the way for you. You may, I don't know. We can't tell you how to trade and what to do, but if you're sitting in a trade, you've got a bit of a risk on. It's a 50-50 bet whether it moves back down on the number or it shoots high and you get stopped out. So if you're not too far offside on a trade, if you don't like it going into a big number, traders, you can take money off the table. You can book a smaller loss and see what happens after. Because what I see a lot of traders do is they let it ride, and it's a gamble. Sometimes I'm happy to take a loss, even if I would have been right if I held the trade, because the other side is I could lose even more if it went against me. But it depends on your reason for the trade. If you had a longer term fundamental view, then the CPI data is just maybe short term noise. But definitely we're bang in the middle here, and not somewhere I would like to trade myself. Guppy, again, we look a bit clear where the levels are. Short term, we've got these highs up towards the high 161s. We're not far off. They're not going to stand for much, potentially on a big number. So if we do get a break there, you're going to be looking up 164, 165 maybe as your next points of resistance. Downside, again, the support looks pretty solid. 155s. It's almost a mirror image of cable, really, and down towards 156. So you've got several areas coming in here, 157.5, where if the market sells off the pound, those are levels it's got to break. If it can't break there, you know what to do. Let's have a quick look at oil, which I'm keeping a close eye on, because I am wondering if we're going to get a move up to this 82 level, and whether we get a break or not. As I say, there's certain aspects that are lining up to say that oil moves up more easily than it moves down. And for the moment, the trend is your friend, at least for the short term. It's keeping this move going at the moment, but we need to get above this 80 level. Then we push on to 82s. Can't break 82s, then we're confirming the range again, and we're going to play 72, 82 ping pong, which gives us some good numbers to trade. 122.50 may be a till if it pivots there, says Angela. Yeah, I'm not sure that's cable again, isn't it? Yeah, a few people have got stuff in this 122.50. I've got it around 60, so we're there or thereabouts. Yeah, it could be a bit pivotal. You know, when we got that drop from 124, that's where it went into trouble. It was a former support point, then it broke, then it became resistant. So, you know, very clear on the technicals, very clean. So yeah, that's your first level, but for cable, that's pretty close for me. And Aussie dollar is stabilizing, holding just below 69.75 on the 4 hour. May short see the data fable. Yep. As we looked at that earlier. Me and my zones. So yeah, we've got resistance coming in just below this zone at 80s and up to 71. But again, you've got to be careful, and you know, a number's likely to either way is likely to move through this if it's anti-dollar, if you like. You've got to allow for that volatility over these numbers. So be careful just jumping straight in with that one. Dollar one, another quick look at one. I mean, we had the failure at 684, stuck its nose above, got slapped, and now we're coming down again. It is just holding this minor area here, or it's moving around this minor area here, 681.90, 82s. It is holding a 680 break, which is good for me. It's not even testing that. So I'm happy with that at the moment, but I want to see a move above 684. If the data gives me that, I'm probably going to chip off some of the position just to put some in the bank. Maybe bring it down to half, then that will give me a free trade. I can pull my stop up a little bit and give me a free trade to run into it. I might also keep an eye on this dollar mex as well, because it is a big old level down here, isn't it, Stel? And it's like you say, a bit of a trapdoor underneath.
Copycat. No, I really like it. I talked about it before. I really like that, and it is trapdoor, and I think there's going to be a lot of technical selling if that breaks. Obviously, this can be a danger, because the worst thing that can happen is a breakdown, then you come back up, so it's a false breakdown and you're out straight away. But I like this, for this to work, inflation today has to be a lot weaker than expected, and if that happens, this is going to break straight through. I'm just going to sell it wherever I can. I will not have a level. It's get in the trade as quickly as I can, and then where your stop is, above these lows, basically slightly above these lows, and see what happens.
So you wouldn't wait for a confirmation in this case, in case it fakes you out. You'd go in it.
If it's a very bad print, I'm gonna go straight in. If it's a marginally bad, and I mean weak CPI print, I'm probably gonna wait for confirmation. But it's all gonna depend on how it's, on price action. I really don't know.
Yeah. I mean, how far would you chase it? Would you chase it down to 1840, or would that be too much for you? You'd want to catch it at least sort of 1849, 47s or something, wouldn't you?
No, I would go towards. I mean, again, if the number is particularly bad, I would go all the way down to 1840. I think, yeah. If I can't manage to get it early enough, because this is going to gap. If it goes 1846 channel support. Okay, that's interesting. Yeah, cool. So we're not going to hear from you over the CPI, except for you mashing your mouse button. I'll be there.
Yeah, and we will be covering that live. Dale hasn't got a guest today, so we'll all be covering that live, the reaction from the CPI. So make sure you're on the Face Show later, of course. Unfortunately, no K-Man today. He's a little bit under the weather, so he's popping off to the docks to get checked out. Hopefully all okay there. That's what happens when you go out on a Tuesday night, still. See, you can't handle it at our age.
I remember the Thursday nights in the city, man. Those were tough.
Oh, we had a period when we used to go out on a Monday night. We had a Monday drinking club. Can't imagine that.
No.
Spend the whole week. But you can do that when you're younger. The good old days.
Kay's young enough.
You're only as old as you feel what a person you're feeling, as they say. We won't go into that one. Cool. Right, well, that about brings us to the end. Unless you've got anything else you want to flag up, still?
Not really, no. I'm going to have lots to say after today's CPI, but at the moment, I think we've covered it.
Yeah, definitely. Plenty more data to come this week. So yeah, please, boys and girls, trade safely. You know, if you're in doubt, stay out, let the dust settle, pick up the pieces afterwards. Don't guess what the number's going to be. You might as well go to your local horse racing track and bet on a horse if you want to do that. You know, these numbers can be dangerous, and I don't want to hear any horror stories and see any people losing money when they don't need to. Anyway, come join us on Face. Lots more to talk about, no doubt. And trade safe. Thanks, Del, for all your input. And thanks for all the viewers. And we shall see you tomorrow.
And thank you, Ryan, and everybody. Take care.
Cheers.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.